In this video, I'm going to be answering 10 beginner investing questions. These are questions that I get asked pretty much on a daily basis on Instagram, and also questions that I wish I knew before I started investing a few years ago. I'll leave the timestamps up somewhere on the screen and also in the description if you want to jump to specific questions. We're going to get straight into it, but before we do, one thing I will say is I've actually got a free beginners investing course playlist on my YouTube channel, going through loads of beginner questions in detail, like what is an index fund, what is a stocks and shares ISA, how to choose a platform, and more. I'm continually adding videos to that playlist, so that is a good place to start if you want to learn more about investing. And of course, I've also got loads of other videos on my YouTube channel as well that aren't in that playlist. We're going to get into it, but first of all, my name is Ryan, or Making Money Simple. Weekly content here on personal finance and investing. You can find me on all the other social media platforms, so make sure to drop me a follow. I also sell some products as well, which will be linked in the description, specifically a beginners investing workshop and a spreadsheet. And of course, subscribe to this YouTube channel right here so you never miss a YouTube video. But we're going to get straight into now 10 beginner questions. Question number one then, what actually is investing? The way that I try to explain this is that investing is essentially putting your money to work.
Here comes the money, 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 money.
When we get some money from our salary, from a job, whatever it is, we can either save it, spend it, or invest it. Of course, by saving it, it is good, but it's losing out due to inflation. If you're spending it, then it's completely gone, full stop. If you're investing it, you're essentially giving your money up. You're giving some money up today. You're putting your money to work into some sort of investment or some sort of vehicle. Specifically, we're going to be talking about here stock market investing. You're going to be giving up some money today, putting it into the stock market in the hope of generating a return over the years, over the long term. Then essentially you'll be left with a lot more money in the end than what you initially put in, and that is the benefit of long-term investing and also compound interest over the years and the decades.
Easy money!
Of course, there's a range of things you can invest into. I'm going to be talking about the stock market, then you've got the property market, you have cryptocurrency, there's also other alternative investments like Pokemon cards, art, whiskey, loads of stuff, but that is what investing is in a nutshell. Question number two, why invest? Why even bother investing? Well, first of all, by investing, you're actually giving yourself a chance to beat inflation. As we know, saving money loses out to inflation every single year, which reduces the value of our money over time. By investing, you're putting your money to work and actually giving it a chance to not only beat, but hopefully greatly exceed inflation, which means you can then essentially grow your wealth over the long term. Other reasons why you might want to invest, so you can essentially build your nest egg or your pot up to the point to where you then achieve financial independence. You can then retire early. As we mentioned, you can grow your wealth. You may even have a specific goal in mind, such as paying for a future family holiday, paying for your children's or grandchildren's educations or weddings or something like that. It could be a specific reason for yourself, but the main reasons why we should invest generically is to beat inflation, to grow our wealth, and then hopefully one day achieve financial independence.
Hey, that's pretty good.
Number three, how to actually make money from investing. There are two ways: appreciation and dividends. Appreciation, capital appreciation, gains, whatever you want to call it. This is where your investment goes up in value over time. If you invest £1,000 today and next year that's worth £1,300, you have got capital appreciation of £300. The second way is then dividends, and dividends are essentially cash paid out by companies to their shareholders to reward them for holding their stock. Of course, if you're investing into a fund could contain hundreds, if not thousands of companies, so it's very likely that fund will pay a dividend. Now, some companies won't pay dividends. Often fast growing companies will not pay dividends because they'll be reinvesting all of their money back into the company, but a lot of companies will pay dividends, especially larger, older companies. They will pay dividends, and dividends really are just essentially cash. Some companies will pay them quarterly, some biannually, some annually, and that is then cash that you will get in your investment account whenever that dividend is paid. So capital appreciation and dividends. Number four, what returns can you expect with investing? Now, this is one of the most common questions that I see, and it depends what you're invested into. Ultimately, with investing, the return you will get is the return of whatever you're invested into and what that generates over the next 5, 10, 50 years, whatever it is. When it comes to a savings account, you know what you're going to get. You have a cash ISA where you lock up your money for 1% for 2 years. You know what you're going to get. With investing, no one can predict the future. No one knows ahead of time what you're going to end up with. However, saying that, there is obviously data and history over the last 100 plus years which shows the stock market generally averages around 10% a year, or at least high single figures. If you didn't account for inflation, you're probably looking at, over the long term, over decades, that you should be getting around 7 to 8% per year. Of course, when you're making your own calculations and projections, you may want to be more conservative and use around 5%. I personally do stick to usually around 7 or 8%. Now, of course, that approach is using, broad market index funds. As I mentioned, I've got a whole video on index funds, which I'll link up here somewhere. But if you are buying an index fund, you're owning hundreds or thousands of companies in one fund, that is what you can expect to get. Of course, if you're investing into individual stocks or even individual cryptocurrencies, the returns can be a lot more volatile, and that is why the return you ultimately end up with over the next 10 years will depend on what you invest into and then what return that investment actually gives over that time frame.
Spicy meat. Yeah, boy.
Number 5, passive versus active investing. To put this simply, passive investing is where you track the market. Active investing is where you try and beat the market. So beating the market means you are trying to pick individual stocks to beat the market, or you give your money to an active fund and that manager is then trying to pick the stocks to beat the market. So it's essentially an element of actively choosing which stocks you or a manager think is going to outperform the market. Now, what is the market? Well, generally speaking, it's the S&P 500, which is the 500 largest US companies. That is probably the most tracked and widely quoted index around. You can then take that one step further and look at global indexes such as the FTSE All World or the FTSE Global All Cap. But these sort of large indexes are the market. So with passive investing, you will essentially just invest into one fund that tracks the US stock market or tracks the global stock market, and you will then get whatever return that gives each year. Of course, as we know, over the long term, that should be around 7 or 8% after inflation. But in the short term, it's very up and down. It's a roller coaster. No one knows what it's going to give. But if we take a step back and zoom out, we can see that over the time, these sorts of broad market indexes do go up. But that is the fundamental difference. Passive investing, you are just tracking the market, which is why it's very, very low fee and passive and hands off. Active investing is where you're generally researching companies, trying to find the needle in the haystack to generate a return that is going to beat passive investing and beat those passive investors like myself who are using index funds. That brings on quite nicely to number 6, index funds versus ETFs. So we essentially have traditional index funds and then ETF index funds. So if you have a S&P 500 index fund and an S&P 500 ETF, they will be doing the exact same thing. They're both tracking the S&P 500. They should hopefully both be very low fee. And of course, because it's the S&P 500, they're both very diversified with the 500 largest US companies. But there are some differences between index funds and ETFs. And the main difference is that ETFs trade like a stock. This means we can buy and sell them throughout the day because their price fluctuates just like a stock. With the index funds, on the other hand, you cannot buy and sell them throughout the day. You can only buy them usually at one trading point per day, and then they're valued once a day at the end of the day. With ETFs, because they trade like a stock during the day, they're essentially valued every second when the market is open. The second difference is that index funds simply track an index, such as the S&P 500 or the FTSE Global All Cap. ETFs can also track an index, but ETFs are becoming more and more niche to track specific countries, specific sectors, specific industries. There's essentially more discretion in what they can actually hold in an ETF and what they're tracking. Thirdly, ETFs are generally more accessible, they're available on more platforms, and also usually require lower minimum levels of investment. But point number 4, ETFs usually can't be bought in partial units. If an ETF costs £70 and you invest £100, then you will only buy one unit for £70. With an index fund, on the other hand, you can buy partial units or fractional shares. So if you invest £100, you will invest £100. There are some platforms where you can use fractional shares of ETFs, but most platforms don't offer that. Number 7, income funds versus accumulation funds. Income funds or distributing funds simply pay out all of their dividends as cash to shareholders like you or me. So essentially you will get that cash in your investment account. On the other hand, accumulation funds reinvest the dividends back into the fund to essentially buy yourself more units of the fund. So if you don't need the cash to live off right now, it's much better to reinvest your dividends, because once again, data and history shows if you're reinvesting your dividends, you're buying more units or shares of a fund, and you're going to be growing and compounding your wealth quicker over time. And then the great thing is, once you get to the point where you want to live off of your investments, so for example, I invest into the FTSE Global All Cap, there's an accumulation version and an income version. I'm still very much using the accumulation version, but if I got to the point in 20 years time where I want to live off of my dividends, I can then switch my accumulation fund to the income fund and start living off of the dividends that get paid out to me. Number 8, lump sum investing or dollar cost averaging. This is once again an absolute golden question when it comes to investing. It's a tough decision, But let me give you the stats and the facts, and then hopefully you can come to the best decision for your situation. So lump sum investing is where you put all of your money in the market at once. If you have £1,000, you decide today you're going to invest £1,000, you're going to lump sum that all into the market in one go. Dollar cost averaging, on the other hand, is where you drip feed your money in over time. So you may say you want to invest £100 for 10 months or £200 for 5 months. The benefit of lump sum investing is that data has showed that 2/3 of the time lump sum investing actually performs better, and that makes sense if you think about it, because obviously, as we've seen, the stock market generally goes up over time, so lump sum investing usually performs better. But drip feeding, I would say, is better from a psychological point of view. By dollar cost averaging or drip feeding your money in over time, if the market did crash by 20 or 30% tomorrow or next week, because no one knows when it's going to crash, then many people would struggle seeing lose that amount of money so quickly had they lump sum invested. Which is why if you're more risk averse or got a larger sum of money, it's probably better to drip feed that in over time, just because of the psychological or mental consequences if you did invest a massive sum and then all of a sudden it just dropped overnight. So really, mathematically, lump sum investing is better, but probably psychologically or mentally, dollar cost averaging is better, just in case the market did crash, because no one knows when it is going to crash. Personally, I dollar cost average in every single month from my monthly salary, and then if I do come into any money from, say, a bonus at work, I will then lump sum that in one go. So I'm sort of doing both. Question number 9, coming to the end now. ISA or pension? Now, these are two great accounts to use if you're from the UK. The alternative to both of these is a general investment account or just your standard account, and this has no advantages, whereas both ISAs and pensions do have advantages when it comes to tax. So let me talk you through them. With a pension, we essentially get to avoid some income tax today because our pension contributions come out of our gross pay and go straight into our pension. This means we get tax relief because we're avoiding some tax, and then that money from our gross pay goes into our pension. On the other hand, ISAs, we do not get tax relief. We earn some money, we pay tax, and then we get our net pay, and we have to invest into an ISA out of our net pay, whereas our pension goes out of our gross pay.
Write that down, write that down!
But we always pay tax eventually. Because with pensions, we avoid some tax today. Further down the line, when we get to pension retirement age, we then can take 25% lump sum tax free, but the rest is then taxable. On the other hand, with an ISA, a stocks and shares ISA, once the money is in an ISA, all gains are tax free, all dividends are tax free, all bond interest are tax free. Once the money is in the ISA, we'll pay no tax in the future. Pensions also, if you're working for a company, will offer an employer match. This is 100% free money, and if you have a workplace pension with an employer match, then take that, because that's 100% risk-free money from your employer that they will contribute to your pension. Unfortunately, nothing is available like this when it comes to a stocks and shares ISA.
But wait, there's more.
But another big pro for the ISA is flexibility. With a pension, as I mentioned, that money is then locked up until retirement age. With a stocks and shares ISA though, we have flexibility. We can withdraw at any time with no tax. It gives us the chance to live off of our investments before retirement age, whereas with pensions, we need to wait until retirement age to then access them. Question number 10, finally, global funds or US funds? Once again, another absolute golden question, which I get messaged so frequently about. If you follow me, you know that I personally use global funds, and I'm going to talk a bit about why. But first of all, what am I referring to here? When I refer to US funds, I'm generally speaking about either the S&P 500, which is the largest 500 US companies, or the total US stock market, which is about 2,700 companies. When I'm referring to global funds, I'm generally referring to the one that I use, the FTSE Global All Cap, which has over 7,000 stocks. But there's also VWRL, which is the FTSE All World, and is another global fund. I think if you're getting into these questions, then you're already really winning, because either using a global fund or a US fund is a great way to go. But I personally use global funds, and that is because I believe you cannot predict which country or which industry or which company is going to perform the best over the long term, so I'd rather be globally diversified. The US has performed brilliantly over the last 10 years, and it's the largest economy in the world, which is why there's such an emphasis on US funds. But it's worth saying, global funds are still made up roughly 55% of US stocks. So if you use a global fund, if the US continues to perform well, you're also going to continue to perform well. But it then also offers that insurance because you're globally diversified. No matter which country performs best over the next 10, 20, 50 years, you're going to be fine because you've got a global fund. Although the US has performed well recently, that's not always been the case. 100 years ago, it only made up 15% of the global stock market. That then shot up to 65% in the sort of mid-1900s. It then fell down to 25% by 1990, and now in 2021, it's back up to 55%. So you can see over that 100-year period how it's gone from 15% of the global stock market up to 65, down to 25, now up to 55 again, and that's over 100 years.
That's a lot of damage.
If I'm going to be investing for, say, the next 40, 50 years, I have no idea which country is going to perform the best, which is why I'd simply rather be globally diversified, and then I'll be fine whatever happens, hopefully. And that brings this video to a close. 10 beginner questions answered. I hope this has been helpful. Subscribe for more videos. If you want to see any videos as well, any ideas, just let me know in the comments, and I will see you in the next video.